Hi, it's Adam again. Thanks for joining me. So this episode is going to take a look at a continuation of evaluating what kind of returns you may receive in a project and how to understand what are the returns that are being offered to you. So in the last episode, I talked about the difference between debt and equity, and we looked at a debt deal, right, where you invested in the debt. In this particular project, and we're going to take a look at what's called the Buvinga Project, and I hope that I'm pronouncing it right. I'm sure I'm probably not. Anyway, the Buvinga Building Project. This is another full cycle project on the Small Change website. And in this particular case, what you're going to see is that the investment that was solicited by the sponsor from investors was, in this case, equity, right? So this was not a debt deal. The security was not debt. So there was no security against the properties you might expect to find if you're investing in debt. Instead, in this case, it was an equity investment, which means that you come behind the bank, right? The bank has the opportunity to foreclose on you. So it's higher risk position. But in this particular case, investors not only got a preferred return, right, of 8%, but they were also offered a 75% share of all the profits that came out of the project. All right, so let's take a quick look at that. Here you'll see the project, and you'll see that the actual return was 21% IRR. So I'll get back to that in a moment, but you'll see that the preferred return, so this is like the interest, right, that is being offered. And this only comes out, by the way, you only get paid this if the project can afford to pay you, right? So if the project doesn't have the cash, you're not going to get that. So these are, before the fact, these were all projections. Now we're looking at a full cycle deal. So this is actually after the fact. So investors received an 8% annual return, preferred return, plus they got 75%, all right? So their actual return was a 21% internal rate of returns over 2 years. So they got their money back early, apparently, after 2 years. And that resulted in a 21% IRR. If you want to know what the internal rate of return is, take a look at that episode. There are at least 2 episodes on IRR. And that is a full cycle project, as I mentioned, that offered preferred return plus a share of the profits. That was an equity investment in contrast to a debt investment. If you want to find out more about real estate investing and all the key terms, go to leadersofthecrowd.com/small change, where you can access more detailed information on how to understand these terms. I look forward to seeing you in the next one. Thanks for joining me in this video. I'll see you soon. Bye for now.